It might be a trap. When you see a dividend that looks almost too good to be true, your instincts should kick in. Sometimes, what looks like a golden opportunity is actually a cleverly disguised pitfall. Booyah! Welcome, folks. Welcome to the show. Let's talk money. Today, we're diving into the world of dividends, the good, the bad, and the downright dangerous. Picture this. You're scrolling through your brokerage account and spot a stock or fund with a jaw-dropping dividend yield, 20, 30, even 50%. Your heart skips a beat, and you start imagining all the things you could do with that extra cash flow. You think, this is it, the golden goose. Visions of passive income and early retirement start dancing in your head. It feels like you've just stumbled onto a secret shortcut to wealth. But hold up. When a number looks too good to be true, it almost always is. High yields can be a sign that something's not quite right beneath the surface. That sky-high yield could be a siren song, luring your portfolio onto the rocks. Companies in trouble often dangle big dividends to attract investors, but those payouts might not last. Think of it like a sketchy steakhouse offering free steak in a dark alley. Tempting, but probably dangerous. If it feels risky, it probably is. A giant yield is a flashing warning sign. Why is it so high? What's the catch? Is the company's business model sustainable, or are they just trying to distract you from deeper problems? Before you get hypnotized by the big number, let's put on our detective hats and look under the hood. Dig into the company's financials, check their payout history, and see if those dividends are actually supported by real profits. Remember, making money isn't just about picking winners. It's about avoiding the losers that can wipe you out. Protect your portfolio by staying sharp, asking questions, and never letting greed cloud your judgment. A solid, growing dividend from a great company is the bedrock of a retirement portfolio. These steady payouts provide peace of mind, helping you weather market storms and plan for the future with confidence. Reliable dividends are a sign of a healthy, well-managed business that values its shareholders. But those yields are usually 2, 3, maybe 4%, reasonable and sustainable. These are the kinds of returns you can count on year after year without worrying about sudden surprises or nasty shocks. So when you see a yield that's 10, 20, or even 30 times higher than normal, it's time to pause and ask yourself, why is this happening? What's really going on behind those eye-popping numbers? If a safe 50% yield truly existed, every big investor, hedge fund, and pension manager would rush in, scooping up shares and driving the yield back down to earth. The market simply doesn't leave free money lying around for long, so when a yield stays sky-high, it's not a gift, it's a warning. It's the market's way of flashing a big red light, telling you to look closer before you leap. Often, it's a mathematical illusion caused by a collapsing price. The yield looks huge, but it's only because the stock price has fallen off a cliff, not because the company is suddenly more generous. Remember, yield is annual dividend divided by current price. If the price drops, the yield soars, even if the payout hasn't changed. It's a simple formula, but it can be dangerously misleading if you don't look deeper. Investors are selling for a reason. Maybe there's trouble ahead, a broken business model, or a looming dividend cut. Sometimes the company's future is in real jeopardy, and the high yield is just a symptom of deeper problems. That 50% yield isn't strength, it's a cry for help. It's a sign that something is seriously wrong, and the market is warning you to stay away. If you jump in, you might be catching a falling knife. Chasing after these tempting yields can lead to painful losses and dashed hopes. Don't try to catch a falling knife. Instead, focus on quality, sustainability, and long-term growth. Your future self will thank you. Let's look at a real-world example, the Herzfeld Credit Income Fund, ticker HCF. At one point, it boasted a distribution rate over 50%. Sounds like a dream, right? But HCF isn't a regular stock. It's a closed-end fund investing in risky debt, especially collateralized loan obligations, CLOs. The fund's payouts depend on the performance of these underlying loans, not on steady sales or profits. If the companies behind those loans struggle, the fund's income dries up fast. In good times, the checks keep coming. But if defaults rise, that giant distribution can shrink or vanish overnight. This isn't a hypothetical risk, it's real. High yields in funds like this are bets on risky parts of the economy. If things go south, your income and principal can disappear in a flash. Let's break down the jargon closed-end funds and CLOs. A closed-end fund issues a fixed number of shares that trade on an exchange like a stock. Its price can disconnect from the value of its assets, called net asset value, NAV, trading at a premium or discount based on investor sentiment. Now CLOs. Banks bundle risky corporate loans and slice them into tranches. The safest tranches get paid first. The riskiest, the equity tranche, get paid last, but offer the highest potential return. Funds like HCF buy these risky slices, betting most companies will keep paying. If it works, the payout is huge. If defaults spike, losses can be catastrophic. High yields come from taking big risks on shaky borrowers. It's a high-stakes game. Know what you're getting into. So what are the real risks when you chase a 50% yield? First, credit risk. If companies in those CLOs can't pay, the fund's income dries up. Leveraged companies are already deep in debt. If the economy turns, defaults can snowball. The riskiest slices, the ones promising the highest yield, are the first to get wiped out. Second, price volatility. Closed-end funds trade like stocks, and their prices can swing wildly on fear or bad news. When panic hits, investors dump shares, prices collapse, and discounts to NAV widen. Even if you're still getting a dividend, a plunging share price can wipe out your gains. The trap. You chase income, but lose your capital, winning the battle, losing the war. Here's the illusion. Yield is annual payout divided by price. If a fund pays $1 per share and trades at $10, yield is 10%. If fear drives the price to $5, yield jumps to 20%, even if the payout hasn't changed. High yield isn't a reward. It's a red flag that risk has exploded. The market is pricing in fear, not opportunity. That eye-popping yield is a byproduct of a collapsing price, not a promise of future riches. In HCF's case, the 52% yield was a historical artifact of a price crash. Chasing that yield is like running into a burning building for free money. Don't get fooled by the math. Closed-end funds can trade at big premiums or discounts to NAV, driven by investor sentiment. When optimism reigns, prices can soar above NAV. When fear takes over, prices can plunge far below. A huge discount isn't always a bargain. It's often a vote of no confidence. The market may believe the NAV itself will fall. Closed-end funds face a double whammy: asset values can drop and discounts can widen. This creates wild price swings, much more than most income investors expect. You might focus on the dividend, but your shares could be on a roller coaster. Know the risks before you buy. How do you avoid these traps? Think like a pro. Pros don't chase the highest yield. They analyze the quality and sustainability of the payout. When they see a fund like HCF, they dig into the risks, credit cycle, default rates, leverage, and what's really inside those CLOs. If you can't explain what you own in a sentence, don't buy it. A huge discount isn't always a deal. Find out why it exists. Read the fund's reports and see if payouts are coming from real profits or just returning your own money, a red flag called return of capital. High yield can be financial sleight of hand. Do your homework. Don't get fooled by a big number. The most important lesson for any investor to learn is this: a high dividend does not automatically mean you've found a great investment. It's a common trap, and many people fall for it, thinking that a big payout equals big success. But the reality is much more complex. What truly matters is your total return. This means the sum of all dividends you receive, plus or minus any changes in the price of your investment. It's the full picture, not just the income stream. A fat dividend is absolutely worthless if your principal, the money you originally invested, gets vaporized by a plunging share price. You could be collecting payouts, but losing even more as the value drops. Let's look at an example. Imagine you invest $10,000 in a fund that boasts a jaw-dropping 52% yield. That sounds incredible, right? It's easy to get excited by those numbers. You might get $5,200 in payouts over the year, but if your shares drop in value to just $4,000, you've actually lost money overall. The big yield didn't save you from a shrinking investment. Too often, people focus only on the income and completely ignore capital losses. Don't make that mistake. Always keep your eye on the total return, not just the dividend checks. A modest yield from a solid, reliable company, especially one with a history of price appreciation, will almost always beat a risky high yielder in the long run. Stability and growth matter more than flashy numbers. So the next time you see a crazy high yield advertised, pause and ask yourself, what's the risk to my principal? Is this too good to be true? If you can't confidently say the price will hold steady or rise over time, that yield is a dangerous temptation that could cost you dearly. More often than not, a sky-high yield is a warning sign of sky-high risk. Remember, there's usually a reason for those big numbers, and it's rarely in your favor. Protect your capital, focus on total return, and always do your homework before investing. Research, ask questions, and don't be blinded by big yields alone. Now go make some smart moves and grow your wealth the right way. Booyah!